कैफे कॉफी रे Welcome back to Indianomics. As promised, I have with me Mr. R.K. BAKSHI, Executive Director at Bank of Baroda, and Mr. FARROKH TARAPORE of ERNST & Young to discuss what dynamic provisioning, the discussion paper, can do to banks. Well, Mr. BAKSHI, let me begin with you. Before we started this discussion, you were telling me that there is not enough granularity in what the Reserve Bank has put out. They have done a study for corporate loans, they have done a study for retail loans, housing loans, but rest of the loans are clubbed in as others. This granularity, separating these others into more categories will help. What other suggestions do you have on the paper?
As it is, it's a discussion paper, and I think it will be followed by comments from the various players, and then a draft guidelines, and then final guidelines. Yes, we feel that number one, apparently the way it has come out, it shows that the quality and granularity of data available as it is of a low range. That is where this figures which are coming out. The mix of portfolios of various banks will be very different. The range that comes out in EL between, even say retail, where the classic example of between 0.4 and 11% is too wide. So ideally the banks should be nudged and would be incentivized to move towards the IRB based approaches. But even on a standardized approach, if the solutions have to be given by the bank on a RBI on a bank wide basis, I think more granularity is required. And for that, like you just mentioned, the other loans are very big. It may have banks, it may have sovereigns, it may have other high quality components which for a particular bank may be very high. So I think that needs to be done. For example, even in retail loans, for example, if we see the type of percentages that have been given, they may be quite low for banks which are not having too much of unsecured retail loans. So therefore, a lot of data quality improvement, apart from so many other efforts that need to be done.
So, Farrokh, would you say that initially when this gets applied, actually good banks get punished? Because as Mr. BAKSHI points out, in that other category of 2.26, some banks may have a large amount of sovereign debt, they may have a large amount of debt which is otherwise not very suspect, so they end up keeping more provisions, and those who are below the average also keep the same amount of provisions. So as a starting point on a standardized approach, you will actually be benefiting the bad banks.
Well, you can look at it in two ways, Lata. One is, what is a good bank? And do we really understand what are good banks and bad banks today? I think if you look at the crisis, one of the lessons that's come out is that we honestly don't know, or didn't know, which banks were sufficiently strong to manage and weather through this crisis compared to others which were appearing to be fairly solid but seemed to be fairly weak once you started going through what was there in their bank. The other part is that the RBI has said that we will start with what is there today. So it is unlikely that they will be the potentially bad banks will be able to cut down on their provisioning levels simply because they are moving to this approach. So they will start from a point which is in that sense fairly equal across the banking sector. You're quite right that as banks analyze their own data and enhance their ability to analyze the data, they will find where they are able to manage or improve their or reduce their provisioning requirements or increase their capital expectations, and use that as an opportunity to go back to the regulator, demonstrate the strength of the organization and move to that approach. And as Mr. BAKSHI said, that will also require them to demonstrate that they are able to move to the internal rating based capital calculation in conjunction with this. Perhaps the one thing that this norm is bringing in, apart from of course the strengthening of the system as a whole, is that it is going to incentivize banks to move faster. Right? Because this is stuff which is impacting their profit and loss account of the year. It's not a regulatory capital ratio that is being
capturing the time
maintained.
series of their data and the propensity to loss will be faster, at least on the part of good banks. Okay, Mr. Bakshi, before we get to that point, and my sense is that the paper is not disincentivizing the bad banks enough. They would always want to remain with the average, although they are below average. But we'll come to that in a bit. What is the immediate problem you see? Will this 1.37% itself be quite a immediate burden? Because the RBI says at the moment when they count all the provisioning and floating and specific standard provisioning, banks average is still only 1.03. So for the system as a whole, another 0.33% has to come in the first year.
Exactly, and I think taking from the point that banks should have a starting position of 70% provision coverage, that which those who do not have, they will have a starting gap to be bridged. And then even if we take the standardized approach of 1.37, of course 1.37 is standardized, but 1.04 is not. That is again a system, right? Some bank may be having higher, some bank may be having lower. So definitely even taking the average 1.04, it means a 0.33% additional. So a bank with a 1 lakh crore of advances will need 330 crore of provisions additional per year than on an average basis what they, which for a bank of 1 lakh crore balance sheet may be quite substantial. That's point number one. The other thing is, this is not one time, so every year you have to do. So if the good cycle continues for quite some time, you may have to do it for 4 years or 5 years. So it keeps on building. Of course, the good element in the guidelines envisaged is a capping ultimately, which say okay, not more than 5 years at any time.
Okay, let me take off from that point. As you say, for 1 lakh crore, the additional amount that on an average bank has to keep would be 330 crores. Now we have at least 5 banks which are well over 1 lakh crore. I mean, which are close to 2.5-3 lakh crore, and one fellow sitting at 12 lakh crore. Do you think it would be advisable, Farrokh, that RBI moves to 1.37 in say 3 steps? First, let them get everyone at 1.03 and then go to perhaps 1.2 and then 1. Would that be a suggestion?
I think it's up to the RBI to see how this is going to play out, and I think before they actually make this discussion paper even into a draft guideline, they will have to get bank by bank input in terms of what is their capability to meet these targets. And even if you look at several of the things that are being proposed under Basel III, apart from this, there is a timeline that goes on for well through the end of this decade. Right, so it will have to face this. The intention cannot be that in the hope of averting or capitalizing for the next crisis, you create one today.
Yeah. Okay.
Right. So the RBI will be faced. They will have to be taking into consideration the requirements and exigencies of individual banks, and then look at the system as a whole.
Yeah. What it also brings out is that with these incremental provisioning, whatever is profit remains after these provisioning and dividends goes to the capital. And that capital is also very much required for Basel III. And now Basel III requiring more equity type capital. So this will also reduce the capacity of the banks to do internal generation for capital accumulation.
You know, the RBI says that when you can start using this accumulated dynamic provisioning for that year specific provisioning will be decided by RBI. Now, would you say that is a little unfair?
You can look at it from 2 perspectives. One is that if you had your dynamic provisioning and expected loss being determined on a bank-to-bank basis, then this is indeed unfair, because you will be maintaining provisions based on your loss profile or your expected loss profile, and therefore you should be able to access it when there is a need. But given that all the banks will be maintaining it based on a sector or industry-wide average or requirement, there will be potentially situations where individual banks, because of their lending practice, may need to draw, whereas there is actually no downturn or recession happening in the economy as a whole. The challenge for the RBI is determining this sufficiently in advance, or defining certain objective parameters by which individual banks can also evaluate that if we face this kind of a downturn, or we anticipate GDP growth to be below this threshold, we should also be assuming that with all of this we'll be able to draw.
I guess that's the unwritten appendix, at least one appendix to the paper, where the Reserve Bank will probably have some indications of growth, of credit growth or GDP growth or NPL growth as one of the kickers for the for signaling that you can use this kitty. Okay. Mr. Bakshi, since we know from the calculations made by the RBI that the propensity for loss from corporate loans is a little higher, and for non-housing retail loans is also very high at 2.67, given this, that your provisioning also will start trying to match this kind of loss, will there be a disincentive for banks to go to those sectors and prefer housing loan? Do you think that banks' behavior will start changing because it's advantageous to get into housing loan?
Housing loans have been attracting attention of the banks anyway, because this behavior only validates that, this statistics only validates that the default rates or the ultimate losses suffered in home loans have been much less. But this data, as we discussed earlier, is not granular enough to give pointers. Whether corporate loans is still not that high, other loans is also very high, retail loans other than housing also quite high. So and particularly for banks, as I said earlier, good banks will be incentivized more to move towards the IRB based approaches, which then their own behavior, the behavior of their own portfolio matters more than the generalized behavior of the sector. There are banks with the similar type of profile, portfolio that's doing very well. Within aviation also, somebody may be having advances which are doing very well. So that also,
to that extent, it is standardizing all banks without looking at.
Although very interestingly, the guidelines say that this EL or the standardized EL is for a medium risk profile.
That's right.
And the high risk profile should either keep more or move towards the IRB type of individual working.
Yeah. That is the second. That is the second appendix which I am expecting from RBI. How will they incentivize the lower than medium banks to move to their own internal approaches?
That may happen only by more of supervised reaction, because they will not themselves be incentivized to move to. Rather, the low risk will be incentivized.
Okay, out of time, but the last word from both of you on what kind of changes you might want in the discussion paper. What might you write to RBI in terms of the changes you may want? Farrokh.
RBI has asked 14 questions. We have another 6 back for them. But I think quite clearly what is the time frame that they are anticipating is important, because I think banks will have to start planning well ahead of that timeline. Second is, what are they expecting banks to do in year one? I think a little bit more clarity around that. And perhaps the last piece is, as you said, some of those appendices, so that you get a better sense.
Okay. Well, Mr. Bakshi, before I ask you for the recommendations, a question from me. You have done the rough calculation. 1 lakh crore bank, 330 crores more. That, assuming that they already have 70% provision cover. Yes. So what would you want the kickoff year to be? I mean, FY13 would be asking for too much?
No, I don't think it will happen in FY13 because this is a discussion paper which will then, they will give some time for that, and it's not the quality of data and the issues that are thrown up. As Farrokh has also said, the timelines of course is one thing that are specified, but what we would like, the granularity of the data and the sub-segmentation of the portfolios to be done.
The other loans portfolio.
The other loan portfolio to be done. But other than that, the timelines, and as we discussed earlier, I think they should phase it out, whatever is additional to be done, even if determined, it should be permitted to be amortized in some time to reach to the minimum threshold. Of course, this being an annual exercise, suppose somebody has to do 0.33% every year for the next 4 years, then that amortization is also not something that easy. It doesn't really help. So I think, anyway, to make the banks, I think all risk management exercises, including this one, including Basel, are aimed at incentivizing a particular type of behavior, that you manage your portfolios better, you manage better the risk profiles of your portfolios rather than run risky portfolios, unless you are running very and banks don't run on that. Any institution may run on that, a high risk, high reward type of. So it's basically to have better risk management practices. Otherwise, you will get disincentivized.
No, fair point. No one questions the principle on which this discussion paper and this concept has been put forth by RBI. But clearly, one request or perhaps one observation from the banking sector and those who look at the banking sector is that perhaps Reserve Bank would be well advised to phase it out, as also provide more granularity. There are only 4 categories of loans: corporate loans, retail loans, housing loans, and the rest of it clubbed as other loans. More granularity in data will help. The Reserve Bank giving some indication when this accumulated reserve kitty of dynamic provision can be used by the banks. That kind of clarity and transparency would be most welcome, and more than anything else, encouraging banks to keep more data and become very healthy with respect to their own data would be something that perhaps not just RBI but the banking sector should bring to the table. This is the first ever discussion on this difficult concept of dynamic provisioning. To be sure, in the days to come we will have more clarity on what banks want from the supervisor and what the supervisor wants from the banking sector. Thanks for watching this edition of Indianomics.